Everybody, what's up? Mike Levitt here, head trader at your trading group. I am back in the States. Okay, I was in Dubai trading over the past week, and I just landed a few hours ago, maybe 5 or 6 hours ago. I landed in the US. And I want to put this video out on a weekend. I don't really usually put videos out on the weekend, but when I got off my plane, I went, I went on all my social media, my Twitter, my YouTube. I was checking my email I get a lot of emails from members. And I always ask questions about what do you guys want to hear about? What do you guys want me to discuss a little bit more? And I feel like the overwhelming response so far has been about Fibonacci retracement levels. So I'm going to put this video together. I'm going to go over how to properly use Fibonacci retracement levels. A lot of traders do not know how to use them correctly. A lot of traders put too much emphasis on them. And then a lot of traders put too much emphasis on them and use them incorrectly, which is twice as bad. So I'm going to go over this video with you. We're going to go over some basic technical analysis when it comes to Fibonacci retracement levels and how to use them the right way to identify some really good trade setups and identify some good pullback opportunities to get long a strong stock. Okay, that's what we're going to do. Before I get started into the video about the Fibonacci retracement levels, I had two people in particular that messaged me from YouTube asking if we still had the 30% off. We were running a 30% off special, guys, until December 20th. But good news, we are extending it until Monday. So December 23rd, Monday, the TTG 2020 discount code is still available and will be active until Monday. So for those two people that specifically just messaged me today, because today's the 21st, if you're watching this video, you know who you are. It's active. You can take advantage of it still and get the 30% off. So that's coupon code TTG 2020. And that's a 1-year all-inclusive membership to TTG. That gets you all of my courses, the Beginner Foundations course, the Advanced course, the Options course, Trader Psychology Part 1, as well as all the future courses that are coming out down the road, like Trader Psychology Part 2, Swing Trading. And I'm going to put some more stuff out in the new year as well. All right, so you guys get everything all included for 30% off. And that is now extended till Monday, December 23rd. Coupon code TTG 2020 will get you the 30% off. You guys can just click on the link below in the description. You can just click the link below in the description of this video. And that'll take you to the website, and then you can just enter TTG 2020. So for those of you that are still interested in that discount offer, it's still active. All right. So take advantage of it, and then I'll see you guys in chat. So now let's get into the Fibonacci retracement levels. And the first thing that I need to say about Fibonacci retracement levels is they're not like the holy grail. Right? A lot of traders put way too much emphasis on Fibonacci retracement levels. I've even seen one trader who teaches people that only uses Fibonacci retracement levels and just buys at certain Fibonacci levels, which just blows my mind. Fibonacci retracement levels, like any other technical indicator, is not really best off used by itself and on its own. The point of technical indicators, and this is something that I cover a lot in the advanced courses, is the point of technical indicators is you need to understand how they act in conjunction with another. You want to look for situations where a Fibonacci level is doing this, a trade line is doing that, a VWAP is doing this, the volume looks like that. Those are how you should identify grade A setups, and that's how you identify grade A setups, by looking for understanding and looking for certain scenarios where all of these things come together. But if you're not using Fibonacci retracement levels correctly, you're going to get a lot of false readings. So I teach everybody at True Trading Group to look for certain scenarios and certain setups where multiple indicators are lining up with another. And the Fibonacci level is a big part of that. But if your Fibonacci level is in the wrong place, you're going to get a whole bunch of different signals. So it's important you understand how to use it. Let's start off with Actually, we'll start off with AXSM because AXSM was a good example 2 days ago. So the first thing that you guys need to understand is that when you have um, a gap up, when a stock gaps up, you need to anchor your Fibonacci retracement level from the prior day's close. You start it from the prior day's close, and you move it up to the current high of the day. All right. Now, if the low of the day is lower than the prior day's close, then you start your Fibonacci level from the low of the current day. Let me go to before I get into AXSM, because now since I'm talking about that topic, let me just get into FTSV real quick because that's actually a situation where that happened. So here, let's start with FTSV. So here's FTSV. Here's the opening bell on December 20th. There's the opening bell. Okay. But here is the prior day's close. So there's the prior day's close. And you can see we opened up and we pulled in. We pulled below the prior day's close and the stock started moving higher. In this situation with FTSV, because the intraday low is lower than the prior day's close, you need to anchor your Fibonacci level from the current low of the day. So here, I'll take my Fibonacci retracement tool, and this is what we do. We anchor it at the low of the day, and then we draw it up to the current high. Okay, there's your high of the day. All right. Now, it's very important that you wait for that high to be established before you start drawing your Fibonacci level. You wait for your first true identifiable pullback. There's your first true identifiable pullback. So then I can draw my Fibonacci level from the low of the day up to the current high. And what do we start to notice? There you can see the stock finding support at the 23.6 Fibonacci level. My two favorite levels in the Fibonacci are, well, there's multiple levels. There's a 20, and these are the most common levels. There are traders that use some other levels, but these are the most commonly used. The 23.6, the 38.2, the 50, and the 61.8. Those are your main Fibonacci retracement levels. I prefer to trade off of the 23.6 and the 38.2, and also sometimes the 50. Very, very rarely will I ever use a stock that trade a stock that pulls all the way into the 61.8. So the higher that stock holds on the Fibonacci levels, okay, you have to understand what the Fibonacci level is. It's a mathematical equation that calculates a percentage of a pullback of the move the stock made. So you're talking about the stock going from this price point up to this price point, and then a mathematical equation calculates where those retracement levels are, and the higher up the level that you hold, supposedly the stronger the stock is because it's holding at a higher price point. It's not pulling back in a majority of the move. So when a stock pulls back in to the 61.8 line, that means the stock has pulled back in more than half of the move that it just made. That to me is a sign of weakness. I like stocks that can't pull back in that far. I like stocks that hold the 23.6 or the 38.2 because that's showing me support moving up and demand for that stock moving up. And I think they have a greater chance of the stock pushing higher. I think once you start to get down to the 61.8 level, I think you have a greater chance of that stock failing. So I prefer the 38.2 and the 23.6. I will also sometimes pull the trigger on the 50, but I most commonly use the 38.2 and the 23.6. All right. Now, in this situation with FTSV, you can see that from the low of the day up to the current high, we get a pullback into the 23.6 Fibonacci level. Now, what did I preface this video with saying? That I don't think that you should ever just use a Fibonacci level by itself. I like to look for there to be multiple indicators showing me something and giving me signals in the same area. And what else do you see here at the 23.6 Fibonacci level? This yellow line on my screen, which is what? The trade line. This is the 9 exponential moving average. So now I've got the 23.6 Fibonacci level that lines up with the trade line to create a nice little area of support. And then right here becomes your buying zone. And then here you get this nice strong extension move up to new highs on FTSV. And that is how you would have used the Fibonacci retracement level in conjunction with the trade line to identify an area of support, a buyable pullback. Once you see support holding in here, the trade line sitting there at the 23.6, then you get a real nice continuation move higher on FTSV. All right. That's how you would properly use your Fibonacci retracement level in the event that the intraday low is lower than the prior day's close. Okay. Now, let's go to AXSM. AXSM was different. Okay, this is the 19th. Now, AXSM had a big gap up. So now that we have a big gap up, what do? We anchor it at the prior day's close, and we take it up to the high of the day. So the gap up high, that's your high of the day, and the prior day's close is your low. So that's how you would anchor it at the low, you draw it up to the current high, and then you look to see where we finding support. Well, what do you see here? As you can see, for 4 consecutive 3-minute candles, we found real nice support at the 38.2 Fibonacci retracement level. There's the 38.2 Fibonacci level. So this is how you would plot your Fibonacci retracement level if you have a stock that gaps up, and in this event, the prior day's close is lower than the intraday low. Your intraday low is right there. The prior day's close is right there. It's lower than the intraday low. Okay, so that's how you guys would plot your Fibonacci retracement levels in this case. Next, the stock makes a new high. So now what do you do at your Fibonacci retracement level? Now that the stock made a new high, you can no longer leave this Fibonacci level here at the old high of the day. Now that there's a new high of the day, you have to draw your Fibonacci retracement level up to the new high. When we do that, now what do you notice? The 23.6 Fibonacci retracement level is now an area of support. But what else do we have? The trade line and VWAP all sitting on this same little area, providing some support and providing a buying zone in front of this level. And you can see the stock continued higher up to $105 a share. That is how you would use your Fibonacci retracement levels in this situation when you have a stock that gaps up and the intraday low is higher than the prior day's close. All right, that's how you would anchor that Fibonacci retracement level. And guys, the anchor point remains the same, and then you just pull it up to the new high of the day. All right, we'll go through one more example, and that's RAD, Rite Aid. All right, we'll have one more example. This is RAD, Rite Aid. So here we are, RAD with a gap up. Now, what do we do here? Here's the intraday low. All right, where's the prior day's close? Right there. Prior day's close is lower than the intraday low. So what does that mean? We draw our Fibonacci retracement level from an anchor point at the prior day's close, and we draw it up to the high of the day when we get our first pullback. Here's your first pullback. What do we notice? The 23.6 Fibonacci retracement level. All right, and then you have VWAP and the trade line sitting directly underneath it, and we just are coming off of one of my favorite triggers, a trade line VWAP crossover. That's something that we'll cover in another time. I have other videos about the trade line VWAP crossover. You could just go back through my channel and find some videos on this pattern. This is also covered in great depth and detail in the advanced course section, the trade line VWAP crossover. It's one of my favorite breakout catalysts and one of my favorite breakout triggers. So we have a trade line VWAP crossover in this situation lining up with a 23.6 Fibonacci level, and that gives you an area of support on your Fibonacci's, and then you can see the stock pushes and continues higher. This little pullback shows you a buying zone, okay, right in that area with those indicators lining up directly underneath it. Then what happens? We make a new high, okay? So now we have to drag our Fibonacci level up to the new high of the day. When we do that, what do we start to notice? What is holding support again? You guys can see the 23.6 Fibonacci level continues to be support, and then the stock pushes and continues higher. All right. But again, now guys, these are clean examples of Fibonacci retracement levels working. They do not work every time. Okay, so that's why I'm saying, you don't just want to rely on Fibonacci retracement levels by themselves. Sometimes a stock's price action will not follow Fibonacci levels at all. It'll pull through the 23.6 and it'll find support somewhere halfway in between the 38.2 and the 23.6. It'll pull below the 38.2 and find support halfway in between the 38.2 and the 50. And there's no way, you can't just keep putting buy orders in at every single Fibonacci retracement level and just when you get filled, waiting for the stock to bounce back, that's not a good trading strategy either. So you have to use Fibonacci retracement levels, but at the same time, they're not the holy grail. You have to use them in conjunction with other indicators to identify grade A setups. You want to see, what's the volume doing at certain moments during a chart setup and during a chart pattern. You want to look for other indicators that are lining up in that same Fibonacci level. If you have two or three other support indicators that are lining up in the same area as a key Fibonacci level, that's a good setup, and you should probably pay a little bit more attention to it and start to focus on possibly giving it an entry. But again, Fibonacci's don't work all the time. Nothing works all the time. There's no pattern. There's no technical indicator that works 100% of the time. It does not exist. All you can do is use these indicators to identify high percentage probability patterns that more often than not resolve one way or the other. But you're never going to find something that works 100 times out of 100. You want to look for things that work 65, 70 times out of 100. Those are the setups that you want to put yourself in, okay, because you have a higher probability of it working out one way or the other. Okay. So that's really how you want to use Fibonacci retracement levels. And guys, again, all of this stuff, all the technical indicators, the trade line view crossover I mentioned before, Fibonacci retracement levels, all of these things are covered in great detail in the advanced trader courses that are part of the TGG curriculum. So again, in conjunction with me talking about this, using Fibonacci's properly, the 30% offer is still live. All right. So if you want to take advantage of 30% off a 1-year membership, that gets you obviously chat room access, the text message alerts, the swing trade alerts, as well as all of the courses, the stuff I'm showing you right now on YouTube, just the free content that I put out to help you guys help speed up the learning curve for you, is just the tip of the iceberg. There's a lot more that goes into properly analyzing these things and identifying grade A setups and only trading grade A setups. That's how you become a sniper, not a machine gunner, by being able to only go after and trade A setups. You don't want to waste your time with B and C setups. You'd rather trade a pattern that works 68% of the time than a pattern that works 50% of the time. And by being able to use these indicators properly, that can help you do that. So again, if you guys want to take advantage of the 30% off, we extended the offer until Monday, December 23rd, where you get 30% off using coupon code TTG2020. Click on the link in the description below. It'll take you to the website. And then after the 23rd, that discount drops down to 25%. All right. So you guys have a couple more days to take advantage of it. Have a great weekend. Rest up. Come back Monday, ready to rock and roll. We've got a short week next week because it is the Christmas week. Markets are closed on Christmas. Christmas Eve will be slow. The day after Christmas might be a little slow. It's going to be kind of a funky week. But I think there still will be some opportunity as the markets are trading at all-time highs. And we'll see what happens. All right. So I'll see you guys in chat. Take care, everybody. Enjoy the rest of your weekend. I'll see you on Monday. Later.